Welcome back to Java. Thank you kindly for joining me. It's December 9th, 2025. It's also Tuesday. Prior to the market open now this morning, we could be facing the economy a two-pronged shock. We're also getting Jolts data this morning, so we've got a bit of a divergence. We'll talk about those. And as always, let's get started with what's going on in these markets. Now, fair grade meters at 31. So edging back up in a bit of the green territory, coming back up with the markets yesterday, was green and then weakened towards the rest of the day, which is kind of what we saw in the morning. What we're watching is retailers and then institutional selling going into these retailers, using them as liquidity. And why do I say this? And where am I getting this from? What I'm watching is the volume and then the number of trades as well as the timing of the day. So when you kind of put those together and you see the pattern repeating itself, you can kind of deduce that that is what is going on in these major indices. So I see a little bit of that continuing, but we'll talk about some of the underlying now. Still, retailers believing in the buy the dip mentality, which is indeed a good one to have. However, I think they are unable to truly gauge what a good dip is. So we'll talk a little bit about that as well. We've got the 10-year yield is on watch. Right now, 4.163, because this whole thing is all about inflation, the dollar debasement trade, and the relative strength between other trading zones. So with this, we've got the relative strength of the dollar at 99.08. So dollar is actually, while this looks down, has gained a bit of strength. This is sucking a little bit of money and liquidity out of stocks, and cryptocurrencies are weak as well. So we're watching the shift, also money flowing into bonds. So kind of a little bit of a fear trade prior to the Fed is speaking tomorrow. They come out with the rate decision, 2 p.m. But really, what everybody watches is when Jerome Powell speaks, and that is at 2:30 in the afternoon afterwards. So he takes questions, and what we're looking at is the narrative going forward as far as the direction for the Federal Reserve. And a lot of the talk is about, it's really all about inflation, but they call it different things. So, quick look at how the stocks are positioned at the moment. Stock market a bit weak, and this is the push up of real assets. So, gold, silver doing really well. Oil is a bit of a third party story because it's more about manipulated supply between OPEC and the war zones. But what we're watching is the volatility index. That's a mild move, but it's at a very low indices. And if that increases, as it looks like it should, that would not just increase volatility, but cause more headwinds for the stock market. So our daily driver, we head back over there, is the Federal Reserve is beginning their meeting today. Behind closed doors, we won't hear anything until tomorrow. Now, this whole thing, the debaser trade, and also, as I said, keep an eye on the volatility index, which is the VIX. So that kind of gives us a window into the fear, as long as with the fear grade meter, because it's several factors. And it kind of allows us to keep a bit of an eye on it at the same time while we're watching all of these other indicators. The largest one, always keep your eye on the 10-year yield for the United States in particular, but now we also have to expand to a couple of other countries. Now, this whole economy and the shift, politically speaking, is all about what they're calling affordability. So, affordability is just one of those other names for inflation. But it used to be based on an activist economy. There was a lot of speak about the green companies, the DEI. This whole economy has shifted over the past about year and a half from that to an affordability and paying more attention to the inflation. Now, I think the interesting point is now that everybody is finally seeing the affordability or inflation issue, there is actually much more threat of deflation coming into the picture now. They always tend to lag and they use data that is kind of old. So we look ahead and that's how we can know these things. So the Fed is expected to cut rates by a quarter point, but this is already priced into the market. So all of the talk about the Fed rate cuts, really, it's just a distraction. Doesn't matter. Watch the 10-year yield. There's other works at force here. Now we've got to watch Japan as well. And I am going to add India into the mix, although it's a little bit more difficult because India is not on the radar, so to speak. So getting the data from them is not as readily available as what's going on with Japan. Now, their main central bankers now saying that Japan is getting closer to sustainable inflation. So the translation is affordability, again, just the inflation speak. So the United States has heavy influence on what's going on. They don't want to rock the currency markets, in particular the USD. They are also looking at the United States as a continued backup partner, if you will, in this conflict area that is now an issue with China. So our calendar this morning, we are getting that Jolts jobs report 10 a.m. They're expecting weakness with this unless it's really far out of the rails, so to speak. I don't expect it to be much of a market mover. The other thing is that these reports they're letting out just prior to the rate cut decision are all managed. Otherwise, they wouldn't let them be out. They do manage the information, and it is that method that they use to kind of keep the market on its rails, as well as floating out Fed speakers. So the lack of that tells me they already know what's in this report, and it'll probably be leaked early to those that are close in. So a little bit of market numbers here. As I always like to say, inflation is theft being normalized because everyone accepts it. So I want to talk a little bit about, speaking of debt and this inflation, CoreWeave, they decided to put out convertible notes. In short, they're issuing debt, taking on more debt, and this crashed their stock. And the reason is this amount of money is the whole part of the whole circular financing going all kind of into ChatGPT, the whole AI trade with NVIDIA, that they're all funding each other. So investors didn't like that, and the stock crashed as a result of that. So shifting to Tesla, first semi truck. This is for deliveries. They're looking at the full self-driving, putting into this. They have delivered it to a logistics company, DHL. So this is very positive for both sides on this. And what we're looking at is the supply chain. This is adding a little bit to it. So a little bit more in the picture than just delivering a truck that's electric. And there have been a lot larger, they've been scaling up with their commercial deliveries. So this is not really, this is the first news that's coming out formally, but it's been in the works for some time. So a shift to housing, and also Michael Burry, he's famous for the Big Short. As a matter of fact, back in the last housing crisis, 2008, so he saw that coming forward in this. He's actually bullish, has sizable stakes in both Fannie Mae and Freddie Mac. These two corporations are the government-backed mortgage loan holder processors for the US government. So he's betting on an IPO for these two. They are well positioned. They have been government backed, and the United States president has been talking about taking these private. So if this does indeed happen, then he's in quite a good position here. So another quick word about the mortgage market that underpins a good portion of the economy, because between the mortgage rates, which is what we're also watching, can dictate the housing market, which does flood out via that wealth effect. So crossover to digital banking, I have a couple of things I want to mention before letting you go. Fitch ratings now flagging risk for United States banks with a high cryptocurrency exposure. Now they're talking about stablecoin issuance as well, deposit tokenization, blockchain technology. Why are they targeting this? This is all a bigger picture of how they're regulating these banks. So we're going to be watching more banks merge and just go out of business because this is part of the mechanism how they're going to control this. They can affect all of the credit ratings as well as the, if you will, the reputation of a bank forward if they downgrade them. So they are playing, in short, mobster with some of these banks. And this is their direct quote. However, we may negatively reassess the business models or risk profiles of US banks with concentrated digital asset exposures. So this is nothing short of saying we are going to choose, and if you don't play along with what we want, we're going to downgrade you and hurt your business exponentially. So with this, it's a little bit. They're not even hiding this anymore. How they're managing a lot of this. So don't worry though if you're concerned about the economy. We've always got war in our back pocket. We've got a defense bill now coming out. This is now going more money to the Golden Dome project. They're saying next generation fighters, $900.6 billion in discretionary defense spending for 2026, an $8 billion increase over the budget request. So they're giving them an additional $8 billion over what they requested. Discretionary, meaning that the accounting practice for it, in short, is going to be quite lax in accordance with other standards. So we've got this war budget, massive amounts of money. They can't even fund the government. There is issues with the budgets going forward. However, this will be funding everything in the back end, and they will be able to readjust with these funds. So with all of this, I wish you all a wonderful trading day, and until I see you again, resist.